The problem with society today is that we have a lot of hardworking Americans that know nothing about investing. They didn't teach it in school, so now they're stuck in the rat race trying to get ahead and are busy trying to provide for their family. When presented with the idea of investing, people either reject the idea entirely because of what they've been taught by their parents, or become overwhelmed by the overload of information and never take action due to the fear of making a wrong decision. So I present to you Finfinite Bank, online banking and investing unlimited. We will provide a seamless transition from holding your money to investing your money. We are a bank that takes care of your investments in-house, so there is no transition process. When allocating your money towards investing, you'll be presented with one of these three tiers depending on your net worth. The majority of our customers will start with Tier 1, but that's okay because these three tiers will also serve as stepping stones to help our customers grow their wealth. Now let's talk about Tier 1. Tier 1 will only be focused on the stock market. Our trained account managers will use tools and aggressive strategies to obtain a 10% growth each month with our customers' money. The bank and its employees will make money on a commission basis that uses the 70-20-10 rule. Customers will be allowed to make 3 withdrawals a year from their savings and principal contributed to investing, but will only have access to 50% of the interest their money makes one time a year. This is to incentivize long-term investing. The goal of Tier 1 is to help our customers reach a net worth of $1 million so they can utilize Tier 2, which I will cover later in the video. According to CNBC.com, we can see a good demographic of what the savings account looks like according to age. 34 and younger have roughly $3,700 in their savings account. Ages 35 to 44, a little over $10,000. 45 to 54, about $15,500. 55 to 64, $17,500. With similar convenience as adjusting the brightness on your phone, a customer could simply choose what percentage of their savings account they would like to allocate towards investing. After calculating an overestimated 37% tax for short-term capital gains, subtracting the commission fees, and assuming the customer doesn't make any withdrawals or additional contributions, we can turn $1,000 into $1 million in just 19 years. How the bank will make money is by sticking to its 70-20-10 rule, where the customers receive 70% of the profit, the account managers responsible for those profits will receive a 20% commission, and the bank will receive 10%. By sticking to this rule, we can assure that the bank will only pull commissions off the profits and interest of our customers' capital, never touching the money that's been contributed to investing. What you're looking at here is a mid-level account that's already gained some traction. In the red circle, you can see the employee commission and the bank commission. Looking at these numbers, you can begin to understand how we can make money and become profitable. Keep in mind that this is only one account, and our account managers will be handling upwards of 20 to 30 accounts at a time, depending on their performance. Now, at this point, I'm sure you have some questions and concerns. Doesn't 120% annually sound too good to be true? Doesn't an aggressive trading strategy put you at more risk for losing money? And what about when we hit a bear market? Well, I'm about to address those now. Now, when you do the math, 10% monthly does add up to 120% annual return. That sounds advantageous until you look at it this way. In 1 month, a trader can be looking at 20 trading days within that month to achieve their goal of 10%. But when you do the math, that only breaks down to a 0.5% each trading day. You can look at the market on any given day and find hundreds of stocks that have gained 0.05% return or better. Keep in mind that some hot stocks and IPOs have runs of 20% or more during a good trading day. If one of our managers were to get behind one of those trades, they could put themselves weeks ahead of schedule getting to their monthly goal. Aggressive trading strategies put you at more of a risk for losing your money. Common sense would tell you that large potential upside has to come with large potential downside. This is simply a myth. When utilizing modern technology, In software, you can use tools like stop losses to have direct control over the amount of money you can lose per trade, if any at all. Seeing that we would attack trades that have a good indication of strong runs and we would have direct control over how much money we could potentially lose, we would literally be maximizing our returns and minimizing our losses. Now, what about when we hit a bear market or a recession? According to Forbes.com and other sources, bear markets last for a shorter duration on average than bull markets do and have higher percentages of volatility. In moments like this, we would utilize inverse ETFs that mirror the movements of a standard ETF. For example, during the 2008 crash, the Dow Jones dropped over 700% in 7 months. If you were to have invested in the inverse ETF, you could have gained over 100% each month. In essence, Finfinite Bank will be excited for the bear market when it comes because we will make more money in a bear market than we do in a bull market. A couple other tools that Finfinite Bank will use to protect its customers from risk is sentiment analysis, employment scaling, and profit pooling. Sentiment analysis tools scan the internet to see which articles are coming out about certain stocks. Take the sentiment analysis tool Swaggy Stocks, for example. It not only locates the information, but it divides it up into positive, negative sentiment, and also the stock price on the chart. Through a process we'd like to call employment scaling, we will have our employees compete based on their average monthly rate of return. Those employees who have higher rates of return will be promoted to higher pools of net worths of accounts. Now, let's take into consideration, what if one of our employees does not reach the 10% monthly goal? We will take our 1% cut from our higher performing traders and allocate those funds to make sure those accounts in a deficit always meet their monthly goal. Now, let's talk about Tier 2. Tier 2 is all about finding investment opportunities to create passive income that will be deposited directly into our customer's checking account unrestricted. Customers will be able to leave a portion of their funds in the Tier 1 account if they so choose, or put all of their funds towards the Tier 2 services. Tier 2 services have two investment options. One is a safe index fund, and two is accredited investor options. This is the reason why the goal of $1 million was so important. In order to be considered an accredited investor, you have to have a net worth of at least $1 million. A customer would be able to choose to go with the index fund or accredited investor options, or both. If a customer chose the accredited investor option, those funds would no longer be available once invested. Only the profits received from those investments will become available. This is a good look at how a customer could see where their money is being allocated. We would prompt the customer to break their money up into thirds in order to diversify their portfolio. They could leave a third of their money back in the Tier 1 account, a third of it into the index fund, or a third of it into the accredited investor opportunities. The index fund is the simplest form of passive income. If we chose the S&P 500 to invest a third of our customers' money that we saw on the previous slide, our customer could receive $42,000 a year before tax. The reason why the bank would take an 80-20 split on this is because we will be constantly monitoring the market and be ready to convert this into an inverse ETF in case of a market crash. Also, it will be our fee for moving the money into the customer's account. We can use YieldStreet.com as an example to see what kind of options the bank would have in order to invest our customers' money. YieldStreet.com presents art, commercial, consumer, legal, marine, real estate, or fund. The reason an accredited investor would want to use us for their investing versus doing it themselves is that we would handle the investments for them without them even lifting a finger. We would also select options from an elite group that pass our criteria test. We would also profit pool to make sure that everyone is making money, even if the investment option doesn't work out. Each accredited investor option would have to pass these three criteria in order to get on our list. Those criteria are high annual interest rates compared to the market, a good debt-to-asset ratio of 40 to 60 or better, and a record of past success from the owner or project manager. Tier 3 is where things get serious. Our customers would have a net worth of over $5 million or more in order to be eligible for its services. Customers will be considered a private investor with Finfinite Bank in acquiring large real estate assets. For example, a $1 million apartment complex will be owned by the bank but financed by the customer. This could provide the bank and our customers with an annual income of roughly $60,000 to $70,000 a year. The bank would do its due diligence and send out a representative to make sure the asset is worth acquiring, and eventually decide to purchase it or not. Once the asset is purchased, 50% of the profits will go to the customer for allocating the funds, while the other 50% will go to the bank for managing the asset. In essence, Finfinite Bank will provide a service for people who come from any wealth class and provide a convenient way for people to fast track their journey to financial security and secure their financial future. Thank you.